Okay, first of all, I want to thank everybody who is here, ready to watch our panel. My name is Andrew Dix. I am the founder of the Media Group. We're the publishers of Crowdfund Insider, and we cover all aspects of fintech. Well, at least we try to, because it's a pretty big subject area today. We also cover some real estate. So I'm really excited to be able to do this panel today about tokenized real estate, because I think it has a lot of potential opportunity going forward. It's very nascent. We're very much in the early days, and we are very fortunate to have some people that are each doing something a little bit differently in the market, being very successful at it, and they're going to share their information, their knowledge for everybody here today. So I'm going to ask everybody to kind of go down the aisle here, and they're going to tell you who they are and what they do, because like I said, everybody's doing things a little bit differently. It's hard for me to keep it all straight, and we're going to start with Moses here. And thanks for showing up, man.
Thank you for moderating this. We're going to have someone from the media industry who knows what they're talking about and really take this.
I can fake it if I don't know.
Well, my name is Moses. I'm the founder and CEO for Accrue. At Accrue, we slice and dice commercial real estate into $1,000 shares and make it more liquid. Don't ask me the relation to Web3 or blockchain. We'll get to the tokenization piece eventually through it. But yeah, that's what we're doing.
And he's actually from Ohio, from Cincinnati. I won't hold that against him, because I'm from flyover country too. So thank you for having a Buckeye on the stage here with me. Lorenzo?
Hello everyone. It's Lorenzo here from Italy. So nice to be in the other part of the world, actually. As a block invest, we are a bridge between the traditional finance and the blockchain. So we try to bring the blockchain to the institutional guy, mainly the banks, to solve like very particular problem, especially the distressed asset world, which is like huge nowadays, especially after the last 3 years. So this is what we are doing.
Awesome. Thank you for flying all the way over here from Italy. I appreciate that. Yael?
Hi everybody, I'm Yael Tamari, CEO and co-founder at Salablock. We're a US company, but I live in Tel Aviv. So Salablock is solving the liquidity risk problem for property owners. We focus on large yielding commercial assets and enabling any real estate asset managers or owners to balance their real estate illiquid assets versus cash liquid assets. And yeah, that's what we do.
Awesome. Thank you again for flying here too.
Thank you.
It's Sanjay from Roof.
Thanks for having me. Sanjay Raghavan. I'm head of Web3 at Roofstock and co-lead the Web3 initiative. We're a single-family rental industry expert. The Web2 company has been around for 7 years, and we've done $5 million of GMV through the platform. And now our Web3 subsidiary is focused on using technologies such as NFTs and other blockchain-related aspects to simplify the process, make it cheaper, faster, more transparent to transact single-family rental properties using Web3 technologies. Thanks for having me.
Yeah, awesome. And Roofstock, I mean, I blinked and they went from being really small to being enormous. I mean, it really happened so rapidly. So kudos to you, what you guys are doing, and we're going to dig in that more in a second. But I want to start with kind of a big picture question here, not the dirty details, but blockchain, distributed ledger technology, digital assets, Web3. We have all this terminology, this lingo that we tend to abuse and apply in different ways. Stepping back for a second, what does blockchain bring to the real estate industry, as a whole, and just from a very high level? I'm going to start with you, Sanjay.
Sure, and I like to analogize on this a little bit. 20 years back, when people were writing web pages, they were writing them on HTML and they were coding it and creating these web pages. And then today, 20 years later, we just talk about it as the internet and web pages. We don't really talk about HTTPS or HTML and things like that. So when we think about Web3, blockchain, crypto, and all that, I think the analogy is the same. Like these are all technology infrastructure aspects, but what we're trying to get to eventually is a layer of simplicity in how people transact. And the way that we do that is, it's really about read, write, own. So creators and consumers are sharing in this new economy. And it's happening because now you have this concept of smart contracts, which the technology allows you to do. Combine that with something called as programmable money, which a piece of computer code can take and distribute. It can take money from you and send it to somebody else, and take an object from that other person and send it to you, right? So this very unique concept of smart contracts and programmable money is allowing a lot of real-world applications to use, to come into Web3 and do things much more elegantly, disintermediating a lot of the kind of traditional rent seekers. And I think that is the innovation here, and that's what we should all focus on. And in 5 years, nobody will talk about, we're using blockchain to do this, or we're using crypto to do this. It'll just be the way things are done.
And I think the key word for me was simplicity, right? I mean, if you make it just a little bit confusing, my eyes roll back in my head, I fall asleep, and I think there's a lot of people like that out there. So, but simplicity is really, really hard to do. Gail, do you want to share your spin on this?
Yeah, absolutely. I mean, I hope I can break it down to a very simple level. In tech industry, there are large companies, public companies, let's say Facebook, Amazon, Google. If they want to raise some extra money today for buying, let's say Facebook for buying WhatsApp, they will basically sell some shares in the public market. They'll have the money, and then they'll buy a company, right? That's how public companies grow. In some industries like real estate, you don't have that insane level of growth where you get to a place where you go to a public market like NASDAQ, unless you're a fund of real estate assets like a REIT, right? Most asset owners, have around $100 million under management, or maybe 500 million, sometimes $1 billion, right? That's kind of the average. They don't have the same tools, so frequently they run out of money and they get in trouble. I was at a meeting today and with an asset manager, and they said during COVID, a lot of doctors quit their jobs and bought buildings, and now they're asset managing and operating. And then they come to the lenders and say, dude, I'm in trouble. I need $2 million because and they don't have extra liquidity. They don't have those tools, right? Their tools are limited to going to a bank, maybe a private equity institution or something like that. And if they're doctors, they don't know how to do this. They don't know how to play this game. So platforms like ours allow smaller businesses, very traditional concrete and dirt businesses, to have the same type of liquidity tools as, let's say, larger banks or public companies with blockchain, because blockchain is cheap, easy, simple to operate.
We're removing friction, we're removing hurdles, back to the simplicity thing, which I really like. So, again, from a very broad perspective, and we're a global panel here right now, I'm going to ask you, Lorenzo, how big is the opportunity, and we'll narrow it down to Europe since you're European. How big is the opportunity for tokenized real estate assets in Europe?
I mean, in Europe we have basically the same issue that you have here. So no liquidity in this market, because the financial institutions are not able to provide the same way the liquidity to the retail investor and to make liquid asset. So that's why I think it's really big, the opportunity to bring that technology in an easy way, so simplify things, to the big guy, because truth be told, the money are there, but they have a very complex structure, very complex procedure, basically to lend the money. Even if they have the money, but it's really complex. So what we're trying to do is put everything on a Web2 platform, which is directly linked to a Web3 world. So first of all, digitize the information flow, because what is missing is the information. Forget about the token. It's different to represent properly the underlying asset. Everyone forget about the underlying asset, but we're talking about real estate, so the asset. I mean, it is the first thing. So once you have represent in that way the value, will be easier for the big guy to finance in a different way that we can see all the like real estate development or recovering from like bad credit, so this is what we are doing. So it's a matter of show them that they can use the technology. Okay? Otherwise, they can block because we want to disintermediate the banks. Okay, I mean it would be a guerrilla game, but probably at least we think that it's better to include the big bank and work all together to make a more liquid and better market.
Okay, the market's enormous. We'll say that. The European market is enormous, and that's kind of where you're focusing on.
I mean, we have the different use cases, but the bigger one is the non-performing exposure, and after COVID we're talking about in Europe 1.4 trillion market.
Okay.
Just in Italy 330 billion.
So that's it's cool in a good and bad way, I guess. But I want to get back to that in a second. So you're targeting a really enormous market, and you are working in the U.S. So how big is the European market? What's the U.S. market? What's the opportunity here?
Look, it completely depends on how you define the market, right? And who you're targeting, who are you looking at? We're talking about commercial real estate. That's what we're focused on. About $600 billion worth of commercial real estate traded hands just last year. The average amount of commercial real estate that trades hands every year from 2000 to 2022 is $325 billion every year. So when you're looking at tokenizing commercial real estate, when you're looking about creating access, you need to be looking at the segment of the market that you're really trying to focus on, saying the commercial real estate in the United States is valued at $40 trillion or $100 trillion is not the relevant number or not the relevant aspect from my, that's what our opinion on that is. So we're trying to streamline that transaction side of the piece, right? In my initial remarks, I said we're fractionalizing commercial real estate. I didn't use the term token or coin or anything on those lines purposely, because it's all about providing the right access to the right kind of investors, and then also having the right kind of asset managers on the other side. I'll get into that in a little bit, but yeah.
Okay, all right, that's fair enough. I'm going to stick with you because you're specifically tokenizing certain types of assets. But where are we in that process today? Maybe you can explain the type of assets you're tokenizing right now, and then reflect on the rest of the market, what's happening in the United States right now.
Look, we're very, very focused on stabilized income-producing commercial real estate. So we focus on core assets and some core plus assets. There's a reason for that, right? There's people who are creating access to liquidity for asset owners. We're doing that too, but you've got to watch out for the possible risks on the investor side as well. So going after these stabilized income-producing assets, which are managed by reputable asset managers, enables investors and builds the confidence on that side. So when crowdfunding started off, you saw the problem where people thought that they could solve the problem of getting access to capital by going and raising money through crowdfunding. You could get the worst possible product funding just because you're going to go out and sell it to a bunch of smaller investors. You'd be able to get your capital and you'd be able to get out of trouble. Now, you need to solve for that, and that's something that really needed to be addressed. And that's why crowdfunding did not pick up early on. In real estate crowdfunding, you've got a few big names, and there's a handful of them that are really doing well. Because it's not that they screen the investor side of the equation, they really screen the deal side of the equation as well. So you go to CrowdStreet today and you start talking to them, they're one of the largest real estate crowdfunding platforms in the US, right? They're not going to go ahead and list anyone and everyone's assets. Well, they're way too large to the point where they're really just working with institutional assets or institutional developers. But when you're focused on why we're focused on commercial real estate, and specifically that segment for it is, it's the security that it provides to the investors. That's what creates the activity within one singular marketplace, and that's what will that's what generates all the liquidity on there, which is, and liquidity is the end goal for all of us, right? We all talk about how, this will generate liquidity, this will get us liquidity at the end, but how much liquidity does really exist within this space? I know I can tell you what the metrics on our platform are, when every secondary market trades at less than 12 hours, but how often do you really see real estate, tokenized real estate, really trade on the secondary market? It's not happening, not for St. Regis Aspen. You barely see any market movement over there. They're the first true institutional asset to be tokenized. The first asset to be tokenized was mortgage, right? But that's what the problem is.
And you're catering to accredited investors and institutions?
So yes, that's correct.
Okay. What type of institutions?
So we're working with RIAs and wealth managers more so, and then institutional investment managers.
Okay. All right. So, yeah. So you're an enabling platform, right? You're working with other platforms and providers, right?
Yeah.
So what are you seeing in the market today? What types of securities are you enabling right now, and where are we going with that?
Yeah. So our goal is really to, number one, transform the real estate into the digital format. And then, as you said, sell it on other marketplaces that are compatible with tokens. So any marketplace that's compatible with tokens on the Ethereum blockchain or Polygon blockchain at the moment, our tokens can sell on with some API integration. So our goal number one is to really handhold some of these asset managers and real estate owners, because it is not easy for them to grasp the move from Web 2 to Web 3. So that's our first goal. And the second is selling on a marketplace is just one way to monetize. So we call it monetization. So just a very, very simple explanation. I'll give you an example. Let's say there's a $100 million asset, right? That's the valuation of the asset at the time of the movement from Web 2 to Web 3, tokenization. So put 100 million tokens in a wallet, each token worth $1, right? Now, at the tokenization time, of course, with appropriate compliance, it is a security issuance, so you have to take some steps. Each asset owner has to take some steps to be able to sell, and the lawyers handle that. But on the platform, they're able to start selling and moving tokens from their wallet to the investor's wallet. So then there is a smart contract on the blockchain which facilitates the exchange. So once the investor pays the money to the platform, the smart contract automatically allocates the tokens and moves them to the wallet. The wallets each have a compliance wall, meaning the investors have to go through a few steps to prove that they're legit. And so the transaction happens, and it happens in it could happen for savvy investors literally in a matter of minutes, right? You come, you sign up on the platform, you click, go through, upload your ID or take a picture of your ID, transfer the money with crypto or ACH over the bank. You literally could own a piece of institutional real estate like the big guys, with a couple $1,000, right? In a few minutes. That's what it does. That's what.
So are you talking about debt, equity, both?
What?
Debt, equity,
yeah.
both?
You can do equity and debt. You asked about models, sorry. So models-wise, you can facilitate any model. That's also the beauty of blockchain. It's basically programmable contracts. Literally, we're tokenizing contracts. Whatever contract you got, and that's why we have so much variety of our companies and platforms, because we focus on different contracts. So, Roofstock has one type of contract for single family. We're largely focused also on commercial yielding, but a lot of our clients are actually repeat asset managers. They leverage one asset, they buy another, kind of like a dominoes. Large commercial assets, and what are you guys focused on? Distressed.
Yeah.
And every one of these contracts is different, but we can program it and then multiply it. Copy, paste, again, saving money.
Okay, all right. So that's very interesting. I want to jump over to Sanjay here again, because we were having a conversation not too long ago about some recent developments from Roofstock, which I struggled to find until you told me it was on a different website. But Roofstock on-chain is a new endeavor. Your original business is basically single-family homes, rentals, soup to nuts, invest, manage, finance. You just go there and you get it done. But this is different. Can you please explain to me what you're
Yeah, no, absolutely. So, first of all, single-family rentals in the US is a $4 trillion asset class. There's 20 million rental units, and roughly 600 million to 900 million of them trade every year. So it's a fairly sizable market. It's a great asset to hold because we then kind of access inflation-hedged fixed income. And then over a 5 to 10 year period, there's appreciation in the home price, which acts like an equity kicker. So this makes a very interesting non-correlated asset class that's both yield generating and has an equity appreciation feature. Roofstock, the Web2 company, historically focused on making this a simpler asset class for people to own. And so we cater to both retail investors who are looking to buy 1 to 5 properties, to institutional investors who come and deploy hundreds of millions.
What's your split between institutional and individual, and what's the split?
The retail is much smaller. We've historically done 2,000-ish homes a year for retail transactions. Institutional investors typically have a buy box. They have some capital to deploy, and they come and buy several hundred to several thousand assets, right? So that's kind of how it's worked in the past. And what we wanted to do was, even though it's a very interesting asset class, when somebody decides to sell one of these assets, right, you still go through the traditional process. It takes 3 to 4 weeks to get the closing done. 2 things happen during that time. There's a lot of diligencing of the asset, and there's tons of contingencies that the buyer would put in an offer. So during the first half of those 3 weeks, there's inspections and there's negotiations on price, because you notice that this thing needs to be redone, and that's
it's a huge pain in the ass.
It's a huge pain, absolutely, for both the buyer and the seller. It's a very stressful process. And then the second half of that 3 weeks is spent on the closing process, which involves sending money to escrow and then getting the HUD statements prepared, and you're going through the closing package. And once it's all done, you fix a date to close, and everybody meets and signs documents, and et cetera, et cetera. We sought out to really simplify it as the Web3 division. We wanted to really simplify that process. Bring those 3 weeks down to just a couple of minutes. And the way we did that is all of the kind of diligencing that happens during the closing, we just moved that to a different part of the cycle. So we moved that up front. So all the information is available in a data room. The buyer can do all that diligencing. But the moment they decide to make that purchase decision, they're just connecting their wallet to an NFT marketplace and clicking buy. 15 seconds later, when that block is written to the Ethereum blockchain, they are now the owner of that rental property. So that's what we've created. We spent the last year or so developing this from a legal and tax structuring and analysis, and we sold our first property in this format a couple of weeks back.
So basically, you'll make it easy so I can go online and look at Miami and pick a home for $5 million and press a button, and bingo, it's mine.
That's half of the North Star. The other half is to really reduce the cost of capital. If you want to buy an investment property today and you want to try to get it financed, we just know the Fed's increased interest rates for the 4th time, 75 basis points again today. The conventional 30-year mortgages are nearing 7% interest rate today. If you're buying an investment property, typically that's 100 to 200 basis points higher, so you're paying 8 to 9% on those types of loans. DeFi on the blockchain has much more efficient capital structure, and so you're able to get lower cost of capital with more flexible financing terms on the blockchain, which again makes it a much more delightful experience to buy rental assets through the blockchain as buying it through the traditional market.
Okay, interesting. I want to go back to the institutional thing since we were just talking about it there. Because Lorenzo, you are working on a what I think is a really, really cool project, and I've been trying to pitch this to everybody because after I heard about it, I thought that's really awesome. So basically, he's banks, and of course, correct me if I get this wrong, and you'll be able to explain more of this. But the banks, they have all these bad loans, and they don't know what to do with it, like a typical bank. And so they want to get rid of it as fast as possible. So they package it up in a bundle of loans and they sell it to somebody for 20 cents on the dollar because they just need it gone. And there's companies out there that say, I'll buy that because, you know, dude, I can make a lot of money off that. And right? And that's what you're doing at scale in Europe now, and you're tokenizing it to remove the friction, right?
Exactly. I know that, I mean, non-performing exposure is quite complex, but I don't know if someone knows how it works and an NPL, raise your hands. No one. Okay, let's make an example. I mean, I'm a bank, and I mean, after COVID, especially after COVID, a lot of people are not able to pay back their loan, okay? So I'm in trouble, because, I mean, the level of exposure that I have in my balance sheet starts increasing a lot. And I, as a European bank, I have a threshold above which, I mean, I'm totally in trouble with the European Central Bank. So I need to sell at a huge discount to like a servicing company or another like small digitized bank, okay? And that player can make a lot of money of it. The thing is, now is no more able to buy from me at huge discount because there is a lot to buy. So now the opportunity is that the bank using the platform to show to the market operator all the underlying asset that is digitized, notarized on the blockchain. On the other hand, the market operator, the servicing company, the asset manager, can leverage on a private accredited individual, okay, issuing, a second token, like a senior token, keeping the junior, okay, and leveraging to the private market, because it's a matter of private market, right? So the servicer is able to provide a very interesting return on investment, at least double digit, because basically you are buying, as you said, 20 cents on the dollar, even less sometimes. So you have a lot of margin. Give you a very simple example of a real use case. 500 billion gross book value, okay? Both with like 101 million euro, okay? With the recovery curve that in 5 years reach 185 million. So from 100 million to 185, you have a lot of margin, okay? Considering that 20% is cost of recovery, you can make a lot of money with it. It's really complex, but the nice thing is that you can make money, but you are also solving a problem, because it's an opportunity, but it's a problem for the society. Because if the level of exposure increases a lot in the banks, when we are going to this guy asking for a loan, the interest rate increase. And especially for what we are seeing nowadays, it's already high. So for the inflation, I mean, the COVID stuff, exposed the bank to find new solution to lower the kind of exposition. And through the tokenization, we found out that you save time dramatically, and also a lot of cost of due diligence, cost of creating a lot of SPVs to issue notes. So through the token, basically you cut a lot of intermediaries and a lot of cost. Roughly speaking, you save 60% of the cost with respect to like a normal operation.
Okay, so the servicer is a specialist. That they collect on the loan. They cut a deal with the
They solve problems. So they make money because they solve problems.
They're not knuckle draggers that come there with baseball bats and say, "Give me the money or else." Right? But they cut a deal. They work with people. It depends.
It depends on the underlying exposition, but basically talking about the secured portfolio, not the unsecured one, because it's another story.
It's different.
The secured is
You guys decentralize risk, so
exactly.
the bank has a lot of properties, and they can't sell them all at the same time. Imagine they have, I don't know, a few thousand or dozen thousand. So they sell it out to all these companies that can go out and sell it off. And they recover more than 20%. They probably recover, I don't know, 70, 80. And then you have 50% to play with. And then the money comes back to the, to the lender. That's it.
To the lender at the beginning, but to the servicer that, actually solve the problem. The main problem that you need to solve is most of the time, like the renovation of the real estate, and also the legal issue that the real estate actually time by time, because you didn't pay back your loan, so you have a lot of legal issue that happen on that real estate.
And as an individual investor, so the servicer, they're managing everything, but they mitigate risk by going out to individual investors that buy a slice or tranche of this security, effectively managed on the blockchain, and so that they've mitigated.
They could be or bonds. Okay, so you can invest in a bonds that basically finance his activities, his recovery activities. Okay, because it has a cost.
Okay.
Or it's a pure derivative token, so it matches the recovery curve.
Okay.
You show to the market, to the investor that you bought at 100 million and that the business plan reached 185, you need to prove that. You
Okay.
need to update the curve and to update your investor.
Okay.
And the value of the token basically match the recovery curve.
Okay, so that's really interesting. I want to keep this moving because we don't have a lot of time. I want to talk about compliance and regulations. It's one of my favorite topics. Seriously.
Everybody.
You know, I love this stuff. Sanjay.
Sure.
You guys are a little bit different. You deal with both single property, just transaction, but you also deal with securities. What are your challenges? How do you mitigate this?
Yeah, so again, in our world, we're not doing fractionalization, which a lot of my colleagues here are doing because they're working with larger dollar volume commercial real estate assets, right? We're dealing with single-family rental assets, so it does not fall under securities purview in the way it's been structured. However, that doesn't mean you don't have compliance and you don't have regulations to think about. In our case, we've gone through, in the US, for example, a lot of these laws are state, defined by each state. So you do have to go and do 50-state analysis to see what you can do compliantly in which fashion in which state. And typically, there's a bunch of these different 50-state analyses that take place, and then you create a big spreadsheet with many columns and say, okay, you can do this, and this in Alabama, and then this, and this in Arizona, but not this. And so you come up with this deep analysis, and then you decide, how can you take this product that we've created, which really simplifies, again, that last mile, right? Bringing down the 3 weeks to 2 minutes. And how can you do it compliantly and in which states, right? So that's kind of the analysis.
Basically, our regulatory environment's a mess. It's a Byzantine clusterfuck because we have 50 states and like a dozen different agencies that stick their hands in all this, but you're managing that.
That's right.
Effectively. That's the key thing here, right?
Exactly. Everybody, I think, should, it's good practice, good hygiene to do things in a compliant way so that,
Absolutely.
Later on you don't, take a small problem and compound it into a larger problem.
It happens sometimes though. Moisen?
Yeah, so look, regulation and compliance is a key aspect of it, and that's something that absolutely needed to be addressed. You can't say, oh, we'll create this digital security for you, and you go talk to your attorney and figure out what that regulation, what that compliance piece is. That's what Accru's perspective is, right? That's what we pride ourselves in. When we started off, our key focus was we need to figure out the right regulation, the right compliance structure for us to do this, and that's how we've approached it. It's not just your KYC and your AML that comes into play. It's about what securities and offering regulations are you offering these under? What are you transferring these under? How's the secondary market working? How's the initial issuance being offered? What kind of exemptions are there? And even after that, how are these being traded between investors, or how are you getting the reporting out to these investors? Where's all that data coming in from? How's that underwriting happening? And all of that is what forms the basis for a truly tokenized asset to be traded every day. You can create digital securities for assets and say, yeah, it's fractionalized. Without the data, without it being compliant, you just can't achieve that tradability, and you just can't achieve the core purpose of digitizing these assets out there.
Okay, so you're saying that you facilitate secondary transactions. Are you a broker-dealer? Are you an ATS? Are you running a bulletin board? How are you doing this?
Yeah, so we run it as a peer-to-peer bulletin board marketplace because in our core belief, real estate is an asset class where there's always some form of price discovery. A buyer and seller will always have to agree on what that price is. A traditional ATS just doesn't cut it for you. Your transaction matching rate is a lot slower on a traditional ATS as opposed to a place where you can actually, where buyers and sellers can negotiate the price down or up to where it is. So we run a compliant marketplace because we're an accredited investor-only marketplace, which is gated on the secondary side. And so we follow very specific exemptions for running that market.
How's your liquidity? Is there any? Is it very?
Yeah, so look, we've had a few secondary market trades on the marketplace in the last year, about $1.5 million worth in the last 12 months, but every secondary market trade has settled in less than 12 hours. Every secondary market sale has caused a gain of about 17% for the sellers, and every secondary market trade, with the exception of one, has sold below below the listed price by the seller. So there was some form of negotiation between the buyer and the seller, which ended up in a transaction which still got the seller a 17% gain, and the transaction took place in less than 12 hours. So when you measure liquidity, is it truly the volume that's happening? I don't think so. It's about how quickly can you sell your equity out to someone else. That's the liquidity piece to it.
Yeah, does your tech stack enable secondary transactions?
Sorry?
Does your tech stack, does your platform enable secondaries?
So also bulletin board style, but mainly we connect with ATSs, so interface with ATSs. That's where more transactions happen because they have more users by virtue of having more users. Also to add to kind of the liquidity philosophy, it depends on what the purpose of liquidity is, right? If the purpose of liquidity is for secondary market traders to make money, it's not going to happen in this scenario. But like Mohsin said, it's important for if somebody wants out of a transaction, they want to sell, why? What is liquidity? So you can have enough money to buy something else, right? Or you run into a problem, if you're an owner of an asset and you urgently need to sell some of your tokens that you still have so that you can fix that, broken, elevator or whatever. So at the end of the day, you have a way, you have an outlet to do it. Will you need to reduce the price? Absolutely, because you want it. It depends on how fast you need to liquidate. So just the fact that there is an outlet for people and investors and asset owners to do that, that's revolutionary. It doesn't matter how many transactions there are in the secondary market, because that's not the point. We're not trying to make money with that in this setting. In the future, when the market matures and we'll have structured products. So Lorenzo was talking about one type of structured product, mortgage-backed securities. When you stack a bunch of things, create a huge product, which they're moving, right? Same thing will happen with the tokens. Large aggregate indices, that's where you can make money with trading, right? You never make money with trading on a $50, $100 million product, ever. That just doesn't happen. Maybe crypto.
So you're absolutely right. The purpose of adding liquidity in real estate is not the reason for, it does not lead to you making money by trading. That's not the core purpose of the liquidity within real estate. The value of commercial real estate lies within the asset in itself. The market can never define the value of the asset. And if you start linking, if you allow the market, the trading platform to decide the value of the underlying asset, you're no longer going to have that non-correlated asset that's going to provide you that hedge against inflation. It's going to take away all the benefits that commercial real estate have. You might as well go and invest in the Vanguard REIT or something, Vanguard REIT or something on those lines, and you'll have that 2%.
No, not Vanguard REIT.
Just, yeah.
I'll go to Roofstock.
No, I was going to applaud my co-panelists here on trying to solve the secondary liquidity issue through ATS and bulletin boards and all that. Yeah, our case is really simple. Our product is sold on NFT marketplaces, so you have the choice of buying an ape, punk, or a property.
Yeah, go buy something that's going to get you a deal, right?
So
You can buy it with a loan
That's
attached, which I think is the coolest product ever.
So how's that going to scale? I mean, I'm just going to be able to go to OpenSea and buy
The seller has a choice to list their property NFT on whatever NFT marketplace they want. We have a native marketplace that's hosted for us by Origin Protocol, but the seller can decide OpenSea, LooksRare, or any other marketplace where they want.
What about your Web2 platform? How are you managing that?
Oh, the Web2 is a completely different. Like our group is 6 people out of 600 that focuses only on the Web3. But there's a whole other company that deals with all the Web3.
I think, is it like a bulletin board, or is it, because you do fractionalization too?
This is just a one property in one LLC, owned and represented by one NFT. So there's no
So
fractionalization.
for your
It's not a-
segment, okay. But what about the original roof stock?
The original Roofstock does have securities products, but those are not on blockchain.
Right, okay. All right, awesome. So we're short on time here, but I think it was you mentioned DeFi lending is the killer category if we get there. And you touched on it at the beginning, but I wanted to come back to this because, you know, I never really thought about this. And so can you kind of share some of that?
Yeah, absolutely, and that's what Neil was referring to as well. You know, this is a very interesting time, both in the traditional markets and in the crypto markets. And the reason for that is, in the traditional markets, interest rates have gone up at an unprecedented rate this year. The Fed has now increased interest rates by 75 basis points 4 times in a row, and it looks like they'll continue doing that in December, at least based on what Chair Jay Powell said today. At the same time, last year in DeFi, there were all kinds of crazy Ponzi projects that were yielding 15
Not in
to 20.
crypto, no.
Well, not in DeFi, but in CeFi and hybrid for sure, there were all kinds of interest rates. And so what we've seen this year is all of those kind of fallacies have collapsed on the crypto side, but at the same time, interest rates have gone up to a level where if you want to buy an investment property today and get it financed, you're probably paying 8 to 9% interest minimum on that product. Whereas on DeFi today, you have a unique opportunity because you can take your stable coins and put it into a vault at Compound or Aave, and you can borrow at a rate of 2% against that, right? Now, if you can borrow at 2%, turn around and lend it to one of these SFR properties on the
Is that 2% fixed or variable?
Well, it's a variable rate. It's algorithmically defined, but
You're scaring me now.
I know. That's how Compound and Aave work, but it's been at around 2% for the last 6 months or so. Now, if you can take a 2% borrowing rate and then you can on-lend to a property NFT at say 5%, you're making a 300 basis point spread on that. And still it'll be 5%, 500 basis points lower than what you can get in TradFi, right? So it creates this unique situation where real-world assets will now start finding DeFi money. And so a lot of those RWA buyers will start looking at Web3 and crypto as a source of getting financing. The crypto investors have a very stable asset class. It's not, volatile like, for example, apes were selling at $300,000, $400,000 last year. The floors fell down to 90 this year. That's a 75% loss in value, within a few months. Here you have a very stable asset that you're loaning against, and you're making, almost a risk-free spread because it's a stable, safe asset. Real estate.
Verified and underwritten.
Okay, so I'm going beyond time here, and they're going to kick me off stage here in a second. I want to give everybody a chance for a final word, and I'm going to start with you.
All right,
first,
okay.
Right? So tell me, what's the future hold?
So the future is part of DeFi lending coming in. Accru started margin lending on the Accru platform earlier this year in February and March. We've got a traditional financial institution that allows you to borrow up to 50% of your invested amount, just backed by your security tokens. The future is digital, the future is fractionalized, the future, going to be the way for transacting in real estate and for investing in commercial real estate. 100%, but it's got to be backed by data and valuations. There's no two ways around that.
Lorenzo, very quickly.
The future is on chain, but if we want to win against the traditional finance, we need to work together. So to create a very liquid market, we need to be able also to work cross-market. Again, not only real estate, but all the tokenized market, because it's going to happen. So we need to use probably the blockchain and find a solution to all together to create like very structured product that can be sold and transacted in full transparency on the market.
Institutional money. Yale, what's the future hold? Very quickly.
So let's say in the beginning of crypto, the motto was be your own bank. Now it's be your own investment bank. So you have the tools like an investment bank to invest in all kinds of different assets, to diversify, to get the data, to manage risk, to to get liquidity, to, educate yourself, and so on and so forth. And that's what blockchain allows, and that's, what we're here for, to spread the word.
Sanjay, very quickly, is it NFTs? What is it? What's the future?
Well, in one word, it is absolutely Web3. And the reason it is because, when there was no Uber and Lyft and people had to call taxi companies, everybody was fine with it because they didn't know there was a better way to do things. And then this app came along and you could just press a button and a cab showed up at your doorstep. It changed how people...
Magic.
Yeah, magic, right?
Yeah.
Web3 is that magic. I think all real-world assets will move in this direction. It's going to happen within the next few years.
Awesome. Web3 is magic. That's the end of nodes. So a big round of applause for our awesome panel. Thank you everybody who's here. Thank you.